The Bank of Canada has held interest rates for the third time in a row, but the market is not listening to anything that they're saying. And this may be really problematic for those debt slaves out there who are wishing for the Bank of Canada to come in and cut rates and cut them fast. But little do they realize that's actually not what's happening, and the market just isn't listening to the Bank of Canada. But I first want to show you this. Thanks to my buddy for sending me this, because obviously the Royal LePage is coming out and trying to spin this in some way that's going to generate some housing activity. And there will be a few dumb people out there who will say, oh my God, the FOMO is back. We need to get into the housing market right now, despite all the data showing the complete opposite of what this person is saying here. And obviously he's the CEO of one of Canada's largest real estate brokerages. So talk about a conflict of interest. And they're basically saying for real estate markets, it's likely more people who need to upgrade their housing will decide they cannot wait any longer. Yeah, because I'm thinking that when the unemployment rate is going up and sentiment is largely muted in the economy, people are going to start thinking, you know what? This is a great time to just upgrade and take on even more fucking debt. I mean, how stupid do they think people are? And even the Bank of Canada during the press conference had to admit that the Canadian economy is in the shit. Take a listen to this.
We've obviously reduced interest rates quite a bit more than the Fed. Our economy was weaker through last year. As we reduced rates, we were seeing actually economic activity pick up with
because of the
inflation
government
around 2%. Of course, the situation has changed with new U.S. tariffs. But yes, we'll watch.
And you could see he's even struggling to come out and basically say that the Canadian economy is completely in the shit, whilst the American economy is doing much better. And that's been the case before the tariffs as well. You're seeing the Canadian economy is really not doing very well. And that's because it was built on a bubble of housing. That one is imploding. Now you've got the immigration bubble imploding, and largely sentiment has changed about immigration, and that's the main thing that you want to keep an eye on. And then you've also got the government bubble in jeopardy. Of all the fucking bubbles, when that one blows, it will be an absolute disaster, because 1 in 4 people in Canada works for the fucking government. So think about that for a second. That is a lot of people who are working for the government and actually taking away from the productivity. But now I want to show you what's going on in the market. Take a look at these 2 gray vertical lines here, because it's kind of important to show that if you basically look at the 5-year bond, which is what most people are looking at in Canada, it's practically unchanged in the past 2 years. May 2023, it was exactly the same as it is today. And in May 2023, you had interest rates that were higher, way higher, in fact. They were up near the highs, but they were at 4.5% back in May 2023. And you've got the 5-year bond in exactly the same place. So you know what? If the Bank of Canada comes in and they cut rates and the bond does nothing, more people are going to have to go into variable rate mortgages and just gamble essentially again. And a lot of people have got burnt on those. And that's the real thing. And what I want people to take away from this video is question the narrative around the Bank of Canada controlling interest rates, because they fucking don't. Just take a look at a chart. They control the overnight interest rate, but that really does not matter to most people. It's the longer term bonds like this, especially when you're rolling over such huge amounts of debt. I mean, who wants to rest a massive $1 million mortgage on a variable rate? You would have to be like a chicken with their head cut off in order to think that that was a good idea. Because, I mean, just look at what's happened in the past for the start off, and you're literally taking inflation as your main risk if you do that. And look at where inflation has been as well. So you don't have to be a rocket scientist to work out that may not be a fucking good idea. And then also I want to show you this because it's very important that when you look at business loans, and these are new business loans, they're not being created. So basically you're seeing that lending on the residential side and to the consumer just continues to churn up and up and up. But what you're seeing with businesses is that's not happening. So business lending really started to tank around June, but now it's coming down massively. And this was June in 2024. So once again, this was before the tariffs. So you really started to see those loans that just went down. And when you look at the balances here, well, they just continue to go up and up and up. So despite the new amount of loans that are being created for businesses just aren't there, the credit balances of existing loans just keep going up and up and up. And people are just not able to really pay those down because they're banking on just more and more debt. And what people don't understand is a lot of this business debt surrounds around the real estate bubble and the real estate market. It is debt that is related to condos, these massive condo buildings and things like that, which is basically a subprime loan market right now and kind of is like Canada's 2008 essentially, which people don't even realize and they're not really talking about because it's a major, major risk how much lending has been ramped up to these developers that are inherently fucking risky. The loans are really bad and the risk departments in those banks should be fired if they let that go by and just say, oh yeah, just keep lending to those developers when like 20-30% of the people aren't closing on those units. Like that's a real good idea, great one. So you're just really seeing the narrative fall apart. And even the Bank of Canada, you know, even they can't hold it together. Even they are saying, oh, the economy, it's not as good as the US economy. So who is really getting hit by the tariffs the hardest? It ain't fucking the United States with all this elbows up, complete nonsense. It's Canada who is being fucked the hardest here. And even the Bank of Canada is saying that. And they elected this absolute clown in Canada, Mark Carney, who said he was going to be, oh, this tough guy. And all we've seen is completely nothing, nada, from this absolute moron who was a central planner himself. He went to the Bank of Canada and the Bank of England. But I think Tiff McClem could probably do a better job. And he did a poor job on inflation, didn't he? So anyway, I want to thank you so much for watching this live stream. And I will see you in the next one. Take it easy, guys. Bye-bye.